Hey there, this is Chris Trapani, the Mortgage Pro. You know, I decided to do something a little different. Instead of bits and pieces of all little different videos on all different subjects, I said, it might be a long video, but let's make a video that's going to cover the home buying process from A to Z. It's going to cover everything. So let's give this a shot. Let's see what we can do. I hope it's not too long, but you can always come back to it. Okay, we're going to get started. Now, as always, if you enjoy this video, hit the like button and you can subscribe so you'll get all my new stuff and you'll learn how the process works and any new changes that come around in the industry. So let's start. We're going to go with step number one. Step number one, here's how it works. People, it's a normal thing. Hey, I decided to buy a house. So they decide and they reach out to a realtor. Well, it kind of seems like it would make sense, but the first thing you really need to do is secure your financing. Because guess what the first thing that the realtor does? He sends you to me. So he can't show you a house or take you out or submit an offer or do anything until he knows you're approved, because way too often it's a waste of time for a realtor. So they make it a rule that they do not show houses pretty much until they know a borrower has been pre-approved. So how do we go through the pre-approval process? Well, what we need to do is we need to verify the most important things that are important to any lender on any loan program. And we start with this. Number one, your credit. Obviously, we have to run a credit report. No, we cannot actually do a full pre-approval if you show us just like a copy or a Credit Karma or whatnot. We actually have to run a mortgage credit report in your name, in our company's name, in order to do that. Now, what's important about credit? Well, there's a couple of things. Foreclosure. If you've had a foreclosure in the last 7 years on a conventional loan, or 3 years on a FHA loan, or 2 years on a VA loan, that would preclude you from doing that. So if you do have a foreclosure a couple of years ago, that just means maybe you can't get a conventional loan, but you could go FHA, or if the case is a VA. So that's not that big a problem. On a bankruptcy, see, this is a very common situation, is 4 years on a conventional loan, 2 years on an FHA or VA loan. So, hey, look, bad things happen to good people. If that was part of your past, look, just got to get past it. It's usually not too bad. So, let's pretend you're past that and you do not have a bankruptcy or a foreclosure, or you're past that time frame. Now, what scores are acceptable? Well, on an FHA loan or a VA loan, you can sometimes get an approval, believe it or not, with as little as 500. Now, on a VA loan, you're really not going to get an approval with 0 down at a 500 score. And on an FHA loan, it would require a 10% down payment if your score is 579 or below. Now, once you start hitting 580 on either one of these type of programs, the approvals will become more and more commonplace. At 580 and above FHA, we're looking at a 3.5% down payment, and on a VA, it's still 0, and they've earned that right, and that's wonderful. Now, on a conventional loan, we're looking at a minimum of a 620 FICO score. At 620, you can be approved for a conventional loan. Now, very often, one borrower with a minimal down at 620 on a conventional loan won't get approved. Now, if you have more than one borrower, it looks at it as we have 2 people we can go to if there's a problem here. So we're looking at it, and you're more likely to get it approved if you have a co-borrower with a very low FICO score. So now you know what you need to do with a FICO score. The next thing we need to do on a pre-approval is, obviously, we have to look at your income. What is your income? How is your income derived? How long have you been on the job? You don't have to be on a job for a long period of time. You could have gotten a first paycheck yesterday. Now, in most cases, we need to see a 2-year work history. It doesn't have to be the same job, but a 2-year work history, we have to prove that, whether it's FHA or conventional. Obviously, you can't be 18 years old, started your first job yesterday. It just doesn't work that way. Now, there are exceptions to the 2-year rule. Let me give you an example. If you were in school and you got a degree, maybe you became a school teacher, maybe you became a radiologist in a hospital, or an ultrasound technician. If you went to school, and we will need to see the transcripts, we will need to see the time frame. You went to school from this time to this time, and that will be acceptable instead of that 2 years. So I recently did a loan for a registered nurse. She went to school for 4 years, she got her first pay stub, and we funded the loan. Why? Because we used the 4 years as the history, and now her new income was $50 an hour. She's doing fantastic, real proud of her. She's in her own home. So we can use that. Now, how do you get paid? Do you get paid salary? Well, salary is easy. If you get paid $5,000 a month, for income we use $5,000 a month. If you are paid hourly, what happens is we have to figure out how many hours you work. As an example, if you work 50 hours a week, you're working 10 hours overtime plus the 40 hours. First, we start with the base pay, which is the 40 hours. And a simple way to figure that out is we work on monthly incomes. So if you're making $20 an hour, multiply whatever that hourly rate is by 173.333. That is 40 hours a week. That's how much you make monthly. So that's pretty simple. Now, if you work less than 40 hours, we're going to take an average over 2 years, because sometimes people work part-time jobs. Hey, did you work 20 hours this week, 22 the week before, 30 the week before, next week you're working 13. When we look at all these things, we have to average them out. We also have to average overtime over a period of 2 years. And if you get bonuses or commissions, again, over a 2-year period. See, income works in reverse. We look backwards pretty much in most cases to see how long have you been making this money. Now, it's okay if you get a raise, if you get a promotion. We'll use that higher income. But again, we're going to use the overtime or commission or bonuses going backwards, and we're going to average it out. If you are self-employed, this is going to be really super important. I don't care if you gross $1 million a year. That doesn't matter. What matters is what you pay taxes on. So if you gross $1 million and write off $999,000, you made $1,000. You're not going to be able to buy a pair of Nikes, never mind buy a house. So it depends on what you pay taxes on. There are such things called depreciation that your tax preparer might use. We're going to add that onto your income also. Sometimes people use their home and a tax preparer will write off some expenses in the use of the home. We get to add that back on. So let's say you grossed $100,000, but you had $50,000 in expenses. We're going to take 2 years of $50,000 last year, and how much is it the year before? Oh, $47,000. That's $97,000. We're going to average that over a period of 24 months, and that's the allowable income that we use. That works for FHA, VA, and conventional loans. It works the same exact way. So obviously now we've looked at the income. We've looked at your credit. We also have to look at your down payment. Where's the down payment coming from? Now, there are down payment assistance programs. That's for another video. They are available. We do have different types of programs. By the way, they're not perfect programs, but they're good. But you do pay a higher interest rate if you take that. Sometimes you have to pay it back in a certain period of time or live in a home for a certain period. So there's different stipulations on that. But let's just assume you're putting a down payment. Now, you are allowed to get a gift for a down payment, so grandma can help you. Mom can help you, cousin Charlie can help you, your best friend in certain circumstance, we have to document the relationship, can also help you. And we can use a gift. It's not allowed to be a loan. You are not allowed to borrow money for the down payment. You can obviously use your savings. You can use your 401k. There's a lot of options and a lot of ways to come up with the money. I once did an incredible job with for this family. I was so excited. It's still one of the proudest things I ever did. Is I had this family. They were 8 brothers and sisters. They all wanted to buy a house. And what they did was, one of them had saved about $4,000, and the other 7 gifted $1,000 each. See, it doesn't have to be one person who's going to gift you $10,000 or $20,000. They each gifted $1,000 each. And the next month, the next brother, basically, he had some money saved, and everybody gifted him $1,000 each. And they were all young, and what they did was they lived together to save the money so that they can help each other. And in 18 months, all 8 of them bought houses. That was one of the coolest things I ever did. And the reason I'm telling you this is I want you to think outside the box. Maybe there are other ways. Maybe even your boss. A boss is allowed to give you a gift for a home loan. So you can do a lot of different things. Now, the down payment required, if you're a veteran, 0 down. Thank you for your service. You deserve that right. If you're looking for an FHA loan, it is $580 and above, 3.5% down, $579 and below, it is 10% down. Now, if you're looking at a conventional loan for a first-time home buyer, you may be able to get a program that allows you to put a 3% down payment, and if you're a slightly lower income, we might even be able to get you a lower PMI rate with what's called a Home Possible loan. So Fannie Mae and Freddie Mac, they have Home Possible and Home Ready. They're great programs that help you save a little bit of money. So I think that's a pretty good deal too. Otherwise, you're looking at 5% down, 10% down. The more you put down, the better the interest rate you're able to get. The higher the credit score, the better the interest rate you're able to get. So all these things come together as far as what we can do. Now, if you're looking at buying a home for an investment, this is a totally different situation. It's pretty much going to be a 20% down, and you're going to be limited to a conventional loan. But for now, I'm going to assume you want to fire your landlord, you want to move into your own house. This is what you want to do. You want to buy a home. People say to me all the time, hey Chris, how does that work, those minimum down payments? Well, they do require PMI. Mortgage insurance, it's called. Private mortgage insurance for conventional, or mortgage insurance premium for an FHA loan. If you're a veteran, you do not pay PMI. Now, you do pay a funding fee that they add to the loan amount. It's a little bit different. Disabled vets don't even have to pay that, which is great. So let's see PMI. On an FHA loan, look, it's going to cost you X amount of dollars depending on your loan amount for PMI. Now, on a conventional loan, if you have a super high FICO score, the PMI rate's cheaper. And if you have a lower FICO score, the PMI rate is more expensive. So when I look at a person and I evaluate their finances and I'm doing a pre-approval, I look at the FICO scores. Because the FICO is going to tell me, hey Chris, where can you save them the most money? A high FICO score, it's usually a conventional loan. A low FICO score, it's almost always going to be an FHA loan is the way I'm going to recommend it, based on the loan amount. Now, every single county has different loan amounts as far as limits, what they do allow you. So we can take a look at that as a whole. We'll figure out what we need to do as far as the purchase price you're looking for. See, here in California, a $500,000 home is not really a crazy expensive home. And I know in many parts of the country, a $500,000 home and you're buying a semi-mansion. So there are different limits based on the average area income and the average area home price. So that's for another video, but here's what we're going to do. We're going to take all your credit. We're going to evaluate the whole situation with your credit. We're going to evaluate your down payment availability, how much you can put down. We're going to evaluate your income, and we're going to say, this is the right program for you. Now, I've been doing this so long, I'm a dinosaur in this business. I know just by looking at a few things, which loan is the right loan for you and your individual circumstances. And most experienced loan officers will be able to do that. So that's a big deal. We take all your information. We're going to look at your pay stubs for income. We're going to look at W-2s for income. We're going to look at perhaps your income taxes. Sometimes people have to provide their income taxes. Maybe they're self-employed or maybe they're commissioned. There's different reasons why we would need to see income taxes. And we're going to enter your income into a computer. We're going to run your credit. Again, it goes into the same software. We're going to look at where is the money coming from. Is the money coming from a gift? Is it coming from your bank account? We're going to enter those things into a computer. We're also going to evaluate some things that we need to do to avoid discrimination and protect borrowers and future borrowers from discrimination. So we're going to ask a whole bunch of questions. We're going to enter it in. And we're going to run it right through Fannie Mae or Freddie Mac's website. And it's going to give us what we call a DU approval or an LP approval, and depending on which one we run. And once we have that approval, we know how much money you're approved for to borrow. And then, and only then, can you really go out with a realtor and with confidence saying, hey, I have a pre-approval letter, I have a DU, that's called desktop underwriter or a loan prospector approval, so that we could submit this with an offer if we decide we find a house we want to do that with. So those are the things that are required for a pre-approval. They are a big deal, and they're complete, and they're important that they're all taken care of. Step number 2, you're ready to go out there with a realtor and find the house that you're looking for. Now, you know, it's human nature. If you're approved for $300,000, most people really want the house that's $350,000. It's just how things work. But it's really important that you stay within your approvability, where you're approved. What's the sense in wasting everybody's time to go see a $500,000 house if you're approved for $400,000? So you have to keep your expectations realistic, and the location. See, a location, in one location, a $400,000 house may be incredible, and another location, a $400,000 house may be 1,000 square feet. So which one do you want? How far is your commute? You need to look at all these things as far as what's reasonable to you. What do you really want in a house? And that's where a good agent is important. Now, there's a couple of things that are really important about the agent that you pick, and we're always there to help you pick an agent that's going to work for you. Number 1, you want somebody with experience. Number 2, you want somebody who's a good negotiator, because they're going to be negotiating. Half their job is finding the house, the other half is negotiating on your behalf to get you the best price. Now, one of the things I personally do is, see, I don't give a borrower or even a realtor the DU approval or the pre-approval letter until I know how much the offer is for. Because why would I give a letter saying you're approved for $450,000 if you're going to offer $425,000 on the house? See, I want to give as exact as possible, because otherwise that other realtor could be saying, yeah, he's approved for $450, but the letter, you know, he's only offering $425. Maybe we could squeeze him for a little bit more. I don't want that to happen. Myself and the realtor you choose, we're going to team up, and we're going to see what we can do to help you get your offer accepted. Now, what do I do to help you get an offer accepted? Instead of just sitting back and waiting for the realtor to make an offer, and right now we are in a crazy time. In Southern California, where I am, if a house is in the $450,000 range, they're going to get not 1, not 5, not 10, but they could get 30 to 50 offers on that one house. So your offer needs to stand out somehow. And usually it's offering above the asking price. Hey, they're going to look at who has the best credit, who has the most likability as far as going to be approved. You know, what deal do they like the most? Because, you know, an agent wants to know, am I going to get paid? Is my client going to go crazy trying to get this done? Or is this going to be an easy one for them? So I personally make a phone call to the agents, and I tell them, look, this is super important. This is Chris Trapani, the Mortgage Pro. I have a slam dunk deal ready to go here. I have a client, they have a 702 FICO score, they have this much money, and they have this much in reserves, and their debt ratio works within the guidelines, and I'm going to try and sell them on what a great borrower you are. And that's what a really good loan officer is supposed to do. So we work it as a team, the realtor, myself, and yourself, if we're working together, and we try and get your offer accepted. And once we do that, we take it to the next step. Okay, let's assume that we worked hard, we worked as a team, we made an offer, we spoke to the listing agent, we got your offer accepted. What's the next step? The next step is we open escrow. And why is opening escrow important? What is that? What is escrow? Escrow companies, what they do is their job is to act as the fiduciary. They make sure everything is legal, that the loan and the buyers, all the information is recorded with the county. They make sure all the money that comes in, your deposit, and all the money coming from everywhere, the loan money, it all comes together. They hold it, and when the time is right and the loan is recorded with the county, they're going to divvy up the money. Now, in a number of states, we do not use escrow companies. In many states, they use attorneys, but basically it's the same process, only the attorneys probably charge a little bit more money. But it's the same process. This is what we do and how it works. So now we've opened up escrow. We're asking them for all the fees. What are we asking them for fees for? Well, there's escrow fees and title fees. And we have to put all the fees together with the lender fees, such as processing and underwriting, and let's see, the appraisal, and how much is the recording fees going to be. And there's all these different fees. Realize that there are probably over 25 people that are going to work on your real estate loan. That's pretty crazy. But there's 25 people. Those people obviously have to get paid. So there's a whole bunch of different fees. Different states have different amounts. Depends on where you are. But we also very often have what's called an impound account. We're going to open up an impound account, which is your personal savings account. And the job of that savings account is every month when you put a payment in, a portion of that money is going to go into that savings account, your savings account, for property taxes, and a portion is going to go in for homeowners insurance, so that when the property taxes come due and the homeowners insurance come due, they can write a check or electronically pay it. That's obviously, I'm showing my age here, writing a check, but they'll pay that money for you out of your account. Now, it costs money to set that account up. See, it depends on what month of the year the taxes are due in your state and what month you're in. As an example, here in California, in the month of September, you'd have to put 9 months property taxes up front, because the next month, 6 months property taxes are due. And they have to have enough money so that when the property taxes come due again every 6 months, that they have enough money. And when the homeowner's insurance comes due, a little piece of your payment every month goes in, so that in 12 months, they're ready to make another payment on your behalf. If you ever sell the house, refinance the house, that money in the impound account comes back to you because it's your money. So we open up escrow, we ask the escrow company for all those fees so that we can put them together in an orderly and legal fashion, so we can give you what are called loan disclosures. Now, the loan disclosures include a loan estimate. The truth is, the loan estimate is not exact. It can't be. But what they do is they overdo and they raise some of the fees on purpose, not that you're going to pay them, but they have to disclose, and they can't, if the fees are too low, they can't raise them later, because that would be illegal in most of those fees. So they put them high, and if anything happens, they're covered, but most of the fees, or many of the fees, will actually be lower. Now, you're going to sign that loan estimate, and that allows us to go to the next level. You're going to sign the loan estimate with a bunch of forms. One of them is an intent to proceed. So that allows us to go to the next level. And the next step is going to be ordering an appraisal. We order the home appraisal because that's a super important step. The appraisal is a protection for you as well as for the lender. See, if you're buying a house for $400,000 and the house appraises for $350,000, you can't get the financing on it. That protects you, and that protects the lender. You have an out to say, hey, I don't want that house. It's not appraising where we thought it would be. Now, an experienced real estate agent, he knows where it's going to come approximately, but he's not a licensed appraiser. It's very much a science having an appraisal. And the appraisal is basically going to go to the lender, and he's going to evaluate it. The underwriter is going to evaluate that as part of the approval process. But before we even get the appraisal, because that could take a week to two, depending on how busy the industry is and the appraisers are right now, we are going to package your file. And what that means is we take your application. We're going to take your credit report. We take the DU approval. Remember, we ran it through the website, their software, to evaluate that. We take your pay stubs, your bank statements, your 401k, your IRA, your documentation, your proof of who you are, your ID, everything. We're going to package it. We have a certain formula for how we do it, and we are going to send it to an underwriter. We don't even have the appraisal back, but we're hoping to get an approval back subject to acceptable appraisal. So what the underwriter's job is to do is to evaluate everything that the loan officer and my staff have put together. They're going to evaluate your bank statements. How much is in there? Does he have any insufficient funds? Did he bounce checks? How does he use his money? They're going to look at those things. They don't overlook at them, but they are going to look at them. They're going to look at your W-2s and your taxes and your pay stubs, and do the numbers line up? Are the debt ratios, do you have too much debt, or are you in line with where you should be based on your income, including this new house payment? They're going to evaluate all that. They're going to evaluate the credit. Is the credit good enough? Does the credit meet the guidelines? There's 100 different things that they're going to look at. Now, my job as the loan officer, I always tell people, and they laugh at me when I say this, I am kind of like a defense attorney. My job is to prove that you meet the guidelines. And I have to forensically prove it on paper. If it's not on paper, or today electronically, it doesn't exist. So, common sense, there's no such thing as common sense. Prove it or it doesn't exist. That's my job, to build a case on your behalf. The underwriter who is sending that file to, they're making believe you and I are lying, cheating, and stealing, and putting together fraudulent documents. They're looking for everything to make sure that you meet that guidelines. Because see, if they do a loan and you don't meet the guidelines, guess what? Fannie Mae, Freddie Mac, HUD, who owns FHA, the VA, say, hey, you buy that loan back. Yeah, write a check. You buy that loan back, because we're not insuring it. So no company wants to deal with that. They would lose a fortune if that happens. So that's why they're going to ask for and over ask for documentation and proof of every single thing. So the underwriter is judge, jury, and prosecuting attorney all in one. They're going to make believe that we're lying about everything. Prove it, prove it, prove it, prove it. And that's their job. See, their job depends on it, because if they have a high failure rate or foreclosure or default rate, the lender is going to look at them, and there's reports on these guys, and say, no, I don't think I want this person working for me anymore. So their job and their family's livelihood depends on it, and that's why they're going to ask you for all this documentation. Sometimes people feel it's intrusive, and it actually could be. That doesn't really make a difference as much as let's make the end justify the means. Let's get you in your own house. Okay, you got the approval. Congratulations. We're excited to make this happen for you. I think that's a big deal. But it comes with conditions. Almost every loan comes with conditions. The underwriter is literally going to ask for certain paperwork. They're going to say, hey, prove to me that that deposit check cleared your bank. And prove to me that, hey, send me the last pay stub. We're missing a pay stub, or something happened here. And hey, write a letter explaining this address that's on your credit report. Hey, there are 3 inquiries on the credit report. Explain what they were. Did you open new credit? So there's little things like that that they are going to ask for. Very normal type of stuff, but you need to do this to meet what's called the conditional approval. And in the meantime, your appraisal has probably come in, which we've also submitted. So once we meet all the conditions, the lender is going to issue what we call a clear to close. And that's an exciting news, because you'll be closing on your home soon. The next step is the closing disclosure, also called the CD. And what the closing disclosure does is it evaluates all the numbers. And these numbers are going to be the real numbers. There's very little that could possibly change in these numbers from the day you sign this. You're going to get the closing disclosures. You're going to work with these numbers. It tells you this is how much money you need to wire to escrow or to the attorney's office. And you have to sign those documents. Now, once you sign those documents, what's going to happen is the clock starts ticking. You are not legally allowed to sign the closing documents. Don't confuse them with the closing disclosures, which you just signed. You're not allowed to sign the closing documents for 3 more business days. Sundays do not count. Holidays do not count. That's just how it works. So 3 days later, you sign the closing documents, and usually, depending on the situation, the company, and the guidelines and whatnot, usually within a day, sometimes 2 or 3 days. Some companies and states will allow them to even fund the same day. So usually within a couple of days, you are going to fund the loan. That means the bank has wired the money for your loan so that we can pay off the seller, and now you become a homeowner. But there's one step left. It has to record with the county. Once all the numbers come together and the funding is there, the title insurance company is going to say, okay, everything lines up properly. Okay, record that loan. And they go to the county and they record the loan. Congratulations, you have fired your landlord. You've gone through this whole video and you've gone through all the steps and you fired your landlord. So if you are ready to do that, reach out to us. You can always go to my website. My website's real easy, fireyourlandlord.info. Click the apply button and we'll help you get started. And if you got something great out of this video, if you enjoyed it, if there's something beneficial, do me a favor, give it a thumbs up, hit the like button, and you can always subscribe again, and I'll help you with anything you need. You'll get to see everything as it comes forward, all the new videos, all the new changes, every law. There's new loan limits, and there's new laws and rules that come about. So feel free to reach out to me, reach out to my staff. We are happy to help you fire your landlord, or maybe we're going to help you fire your neighborhood and move up to a new one. So whatever it is, this is Chris the Mortgage Pro saying, hey, we're here for you. We got your back.